Hello and welcome to our special series on CNBC TV 18, The Informed Investor. The last few years, or perhaps the last decade, has seen Indian investors live through pretty much everything, especially with regard to the equity market. We've now seen a bear market, a bull market, a correction phase, and right now we're probably poised somewhere in between. Along with that, there have been so many changes in many other asset classes, which has begged the question, how does an investor go about choosing an asset class that works for him? How does one invest intelligently, and what kind of mature expectations should an investor have from all these asset classes? What we're going to do over the course of this show is pick up each asset class, discuss the pros and the cons of it, just so that you have a clearer idea of what kind of product works for you and what you should put your money into. My guests today on the insurance subject are Puneet Nanda, Executive Director, ICICI Prudential Life Insurance, S.B. Mathur, who's Secretary General, Life Insurance Council, and Gautam Chickermane of Hindustan. Gentlemen, great to have all of you on the show. So let's get that first basic question dealt with. Puneet, come in on that. Investment as a vehicle and insurance as a vehicle to give that investment out. Would you say that insurance can be treated as an asset class and an investment generating asset class?
I think at its core, life insurance is a product which provides the twin benefits of protection and long-term wealth creation, and nobody can deny that these are two needs that every consumer has. So one has to look at a life insurance product in that light. To the extent that there is virtually no other long-term investment product available in the country, so to that extent, of course, it is considered as a long-term asset class by itself, but at the core it is a combo product.
Gautam, you want to come in on that? Because this is a tricky one for insurance, and this is really the fine line that it walks on, whether it should be some kind of investment vehicle or whether it is actually just an insurance policy, and expectations should be low in that regard.
With due respect to Puneet, I think what he's talking about is the theoretical framework under which the insurance products are planned. But in practice, when you look at the numbers, the insurance industry is too heavily skewed towards investment rather than protection. In fact, protection is greatly needed in this country, and the earlier that the industry starts delivering protection, which is life cover, rather than investment, which is good for the company as well as for the agents, the better it will be for the consumers.
I think what you're alluding to is the hotly debated ULIP issue, Gautam, which I'll come to in just a minute. But just to understand the contours of the life insurance industry, then there's ULIPs, which is one part of the universe there, and there's traditional tools. Just walk us through what kind of tools are available in the life insurance space for an investor to go out and buy or invest in.
Yeah, so I think as any investor, any household, before he begins to invest his money, the first financial product that he must buy is term cover, which is a pure insurance cover on which you get no returns. This protects you in case of in case of death, quite like car insurance, where you don't get your money back. Once you have extra money, then you need to put that money in an investment vehicle, which is a mutual fund, which is the lowest cost product in the world. All mutual funds are no loads and they are transparent. So a nice combination between a term cover and a mutual fund would be the best thing for you. There are traditional plans, there are ULIPs as well, which are interesting products, but not as flexible nor as transparent as mutual funds.
Puneet, what is that defining line that you would draw between a mutual fund product or an insurance product, just to understand the difference for someone who's choosing to invest in either?
No, according to me, it's not either or, honestly. I fully agree with Gautam that the basic financial need of any person is protection, and that should definitely be the first objective. But along with that, investment/wealth creation is also a significant need. And when you talk about that, there are a number of different options available to consumers today. It has to be in the context of the consumer's risk appetite, goals, understanding of markets, ability to invest time, ability to understand the product, so on and so forth. So in that context, there are a number of different options. It starts from a pure bank deposit. There are a number of small saving schemes. There are mutual funds, as mentioned. It can be direct equity, and an insurance product is another such product. What an insurance product offers is a convenience product on the same platform. You can marry the needs of protection and investment.
Gautam, let's take on traditional products first and then we'll get to the more weighty issue of ULIPs. What would you line out as the pros and cons of this product, both in terms of the options available, the fact that it's probably much lower yield returning, and the fact that it does at this point have some kind of tax benefits to it? What's the pros and cons with traditional products in the insurance industry?
See, traditional products, before the sector opened up for private investment and competition, had a guarantee with that product. So you could assume that you would get a guaranteed 8%, 10%, 12%. In that paradigm, whatever your costs were is none of anybody's business, because you were getting a guaranteed return. Once the industry structure has changed, where it has become market linked, even the returns on the traditional plans are no longer guaranteed. Hence, to presume that you will get a such and such return on those plans is incorrect. The second thing I dislike about traditional as well as any insurance product is the lack of transparency. I don't know where my money is going. You don't know where it is being invested. They talk about asset allocation, you break it down here and there, but we don't know where it is in. There is no benchmark.
Mr. Mathur, LIC has been the big daddy, so to speak, in the insurance industry. How would you line out what the new landscape for the insurance industry is, and which of these tools you think are actually more lucrative as an investment option, the traditional products or the ULIPs?
Well, traditionally, historically, ULIP products should give better return because equity has provided the best return over a long-term period. Having said so, the handling of ULIP products, either as a consumer or as a manufacturer, requires a lot of expertise, lot of information. So many people in India particularly are not very financially literate. So in their case, ULIP products may provide better return, but they are not able to exercise proper judgment. Therefore, I would say that ULIP products are good for people who are well informed, who can take financial decisions, and large number of people who are not financially aware, perhaps traditional products are still better for them, though they may not offer such an attractive return.
Okay, let's take a break on that note. Just gotten started with this discussion about insurance products. When we come back, we'll talk about ULIPs. A lot has been discussed on that issue already, but let's try and understand what the changes are, what the new form of ULIP products are, and whether that's something that you can actually make to work in your advantage or not. Be back in a short bit.